Good morning, everyone. This is Tony Butler with Insurance Agency Marketing Services, and I have Brent DeGroot with me today with OneAmerica to discuss some things that's going on with OneAmerica. So, want to thank you for joining us this Monday morning. And as always, going to first talk about a few things in regards to what we offer here at Insurance Agency Marketing Services. Um, so, let's get right into it. So we always like to be able to have an opportunity for agents to earn additional funds, and I have yet to hear an agent uh, decline earning extra money as they're working. So there's a few things that we have available to our advisors in terms of earning additional cash along with commissions. One of those is our new producers builders that we have available here, and depending on your production, there are several perks, if you will, that are available to you as an advisor. If you have any questions in regards to our new producers builders, please do not hesitate to reach out to us, and any of the sales directors can talk to you about this in greater detail. We also have our IMES Business Builders, which is a referral program that we have for our producers. So if you refer an agent to IMES and they get appointed with any of the carriers that we work with, we do provide you with a one-time $50 bonus for getting them appointed as a thank you. We also provide additional dollars for you on the business that they write. We do also have a marketing reimbursement program that we pay out on as well. Again, if you have questions in regards to this, would love to speak to you about this in greater detail. Please do not hesitate to give us a call on that. We also offer back office support for you. We always like you to work smarter, not harder. So there's a lot of resource tools that we have available. One of the big things that saves our agents a lot of time is paperless contracting. That is done all online. So again, want you to be able to work smarter, not harder. In addition to that, or in that vein, the IMES website that we have available for you has a lot of sales tools available to you. And if you're a life insurance agent, you are able to run your own term quote comparisons as well as universal life comparisons. For annuity agents, we do have the annuity rate watch available to you, and electronic applications are available through our website. Now we have two platforms for e-apps. One of those platforms is iGo eApp Solutions, which the majority of our life carriers are on that platform. And the other platform is Firelight. Both of these platforms you can access through our website. If you haven't registered for them, I would strongly recommend that you do reach out to us. We can walk you through getting appointed, or excuse me, not getting appointed, but getting registered on these platforms. And as you see here for Firelight, it has a list of all the carriers that we have available through that platform. And as you see, it is annuity heavy in terms of the carriers that are available on there. We do have a few life carriers available on that platform as well. We also have a creative marketing solutions department, which can help you whether it's turnkey, agency, or digital solutions. And what that means is we can assist you in regards to helping you build your business, build your brand, whether it's with handouts or newsletters or logo design. If you need assistance with a personal website, updating that, or need help with building a website, we can do that for you or assist you with that. I would recommend that you reach out to your sales director and see about doing a marketing analysis where we've spent about 20-30 minutes kind of doing a deep dive in your business in regards to what you're doing and what you're looking to do, and then come up with a plan for you in that regard. So if that is something that does interest you, please again reach out to your sales director. Be more than happy to help you with that. We also have our IMES Wealth Management team for your higher net worth clients. You can reach out to Charles Jr. and his team. They can help you in that regard. And then Lastly, our Life and Annuity Academy. We are done with the academies for this year. I know there's going to be some dates next year where we're going to be doing Life and Annuity Academy. And if you're familiar with IMES, then you are familiar with our 2-day producer training that we have, where we do fly you in. We pay for lodging, meals. And what we do is we talk about industry trends, sales strategies. We normally will partner with one of our top carriers and discuss their products, sales software tools, things like that. And some of our top producing agents will also join and speak on that. I think the last one we had was here in the office, and it was a great success in terms of having individuals do a deeper dive in what they're doing as far as their business, getting some ideas in regards to growing or expanding their business. So I do think I have a polling question in regards to getting additional information on upcoming academy. So I'm going to put that up here real quick. And if you're interested in that, please respond to the polling question. And then we'll move on. I see there's several individuals responding, so I'll keep this up for a little bit. All right. We'll go ahead and close this out. Lastly here, Seaside Sanctuary, our trip. As you see, the trip is slated for next year in April. Qualifications listed here, 4.5 million points. The qualification period is from July 1st, 2022 through December 31st of this year. I believe we have several agents that have already qualified for the trip. If you have questions regarding the trip or where your current status is on this, give us a call. We do have a list of everyone that has produced and qualified, so we can definitely give you more information on that. And with that, Brent, you there?
I sure am, Tony.
All right, I am going to switch this over to you, my friend.
Perfect.
All right, there you go.
Okay, let's do this. Get this fully pulled up. We're going to swap display here. And we'll get running. Well, Tony, thank you. I appreciate it. I know you're a little bit under the weather, so you struggled through that well. Do want to thank everybody for coming out today. Certainly happy to be talking to you about kind of what's going on in the LTC planning space and why so many consumers and advisors are moving more towards this asset-based long-term care planning. And that's really what we're going to be discussing today. So first and foremost, I like to talk about just OneAmerica. In case you don't know us, I wanted to make sure you know a little bit about us. So for that matter, you know, we can trace our roots all the way back to 1877. So more than 140 years in insurance. We are an A+ rated carrier by AM Best. Our current Comdex is 95. So all that speaks to the financial strength. We are a mutual company, and that's where I see most of the carriers that are still in long-term care planning happen to reside. They are mutual companies, and really we're reporting to those same policyholders, not to a stockholder. So makes a big difference there in our planning, design, and certainly paying claims. Innovation, we were one of the first to market with these asset-based solutions. As a matter of fact, our first iteration of asset care, which I'll be talking somewhat about today, was first sold in 1988, the year I graduated from high school. So again, 35+ years of experience in not only designing these types of plans, filing them, administering, and most importantly, paying claims for your clients. So really two types of LTC protection that are out there. Can maybe be argued that there's a third, but the first one is the traditional, the health-based, use it or lose it, which is the biggest objection with the traditional style of long-term care planning. And that's where some of the asset-based AB, LTC, asset-based long-term care, really was the antithesis of why they were created. And this slogan we've had here at OneAmerica for many, many years: live, quit, or die. You know, the client's decision is covered. So if they live and, if they die and never use it, so that use it or lose it scenario on the traditional side, their life is covered, but they pass on a tax-free death benefit to their named beneficiaries. So great way to cover their life and make sure that they've got long-term care planning. If care is needed, obviously they pull that from the death benefits of the policy. So they've got the long-term care income that is needed for any of these expenditures, and the decision's covered. If they decide to walk away for whatever reason, they can get their money back. There is a surrender charges over 9 years, but it's still their asset. They've got access to the cash value and ultimately the death benefit as well. So live, quit, or die, the clients will always get something for the premiums that they pay. So if you've ever seen OneAmerica presentation before and that sort of thing, we can get really deep into the weeds. So I really like to simplify it, at least up front, because if you can understand this concept, you can understand our plans 95%. You know, we can get into the weeds, and I'll get into some of those weeds here in just a little bit, but very, very simple concept. It's a base policy that is their asset. That's what they're going to use first if and when long-term care expenses are needed. So it's either one of the differentiators between OneAmerica and all of our competitors in this asset-based long-term care planning space is the fact that we have both a life insurance chassis, which we call asset care, or an annuity chassis, which we call annuity care. So again, their asset, whether it's the life side, whether it's the annuity side, it's their asset, right? The client gets to use their asset in one of the ways that they really wish. Then we have the ability to add a rider, which we call the continuation of benefits rider. Now that rider, we can go all the way up to a lifetime unlimited benefits. And we see about 62% of our business that comes in all having that lifetime unlimited option. However, we can create a limited plan as well. So it doesn't have to be that lifetime benefit. If you're looking more for average planning, if you will, for your clients, we can do those types of plans too. But one of the things that really separates us here at OneAmerica, again, as well, is that we've got a joint second to die contract on either platform. So we can actually have two people share one policy and one death benefit or cash value amount if it's the annuity chassis, and then add that unlimited or limited basis of the COB rider. And it really brings the true peace of mind there, especially when they have that unlimited amount. And that's why I think we see, you know, over 60% of our plans that come into the home office, our applications, having that unlimited amount. So again, very easy concept. Base policy, it's theirs, their asset. Add that COB rider. That's when the insurance company kicks in. If they exhaust their base policy, the insurance company kicks in, OneAmerica, and we take that long tail risk away from them. So it's really that catastrophic planning when it comes to long-term care. So the biggest objection, now I told you the use it or lose it was a huge objection that we ran into in the traditional style of long-term care planning, but the biggest objection to planning overall for long-term care is just the concept of self-funding. You know, I don't know if this is ever going to happen to me, so I'll just self-fund this risk. Or maybe it's us as advisors that we're passing on maybe some misinformation to our clients. We're saying, you know what, you've got plenty of assets. We don't need to worry about that. Sometimes I think that that's a little bit of a cop-out, only because maybe they don't want to get into the long-term care planning discussion. Now, I'm not saying that's you per se, but I have seen it out there quite a bit. So let's not pass misinformation to our clients. It's very important that if we're building wealth with our clients for their financial future, that we protect that wealth as well. So here's that concept of self-funding and really well-balanced portfolio, right? Well, let's just say we're protecting a couple, because we can do that here at OneAmerica. And one of the spouses goes on claim. So that claim in that year cost $125,000. Now, to their overall financial portfolio, did that make a huge difference? No, it really didn't. It, made a small impact, but they can probably withstand any of that. But that's just 1 year of care. What if they start to have multiple years of care? Or now they both start needing care? How quickly can they eat up that whole portfolio, again, that was earmarked for retirement? It's not earmarked for healthcare expenses, it's earmarked for retirement. And so that's the concept or the objection that we're really overcoming, is that self-funding objection. So here at OneAmerica, again, what's different about us is that here's that well-balanced portfolio there on the left-hand side, but we can take just a repositioning of a portion of their portfolio and create a lifetime of income needed for any of those long-term care expenditures for 1 or 2 people. So remember, it comes out of their death benefit, but there's cash values that are built in, long-term care amounts that are payable, and all of these are guarantees. So no calls from your clients down the road saying, hey, why am I getting this rate increase notice? These are all guaranteed, built in from day one. So no questions asked down the road. So I do get some questions on this when I'm certainly live. And I wanted to really kind of go through the timeline, if you will. So people have asked, well, how can you guys really offer a lifetime benefit structure? That seems too good to be true. Well, I will say this, it's not too good to be true, but it's too good to be free. What do I mean by that? Well, let's follow the timeline here. So day 1 of claim, what happens? We go to that same asset that they took out. Again, remember, it's the client's asset, that base policy, their asset. We go to that base policy and start pulling from that base policy for any LTC expenditures. Now, if they exhaust that base policy, that's when the continuation of benefits kicks in, continues that same income stream specifically for those long-term care expenditures. And again, we can do it up to that unlimited amount for as long as one or either of them would ever need. So again, real good peace of mind here in planning for long-term care. So very quickly, because we're doing this across the nation, I wanted to quickly point out that there's some nuances here. So we do have product in California, although it's an older version. It is the current pricing, but it's an older version. So some of these pieces may not exactly apply in California. Very similar, but not exact. And then we have no products available in New York. So for those of you in New York or California, just be aware, well, in New York, no products, California, little different version. So if I look at asset care, and again, this is our whole life chassis, right? We've got a number of ways that we can create these plans. Remember, it's a very simple concept, base policy plus a COB rider. But we've got lots of ways that we can fund these. It can be a single premium, and that was the advent of all of these asset-based long-term care planning solutions. They were all single pay when it first came out. However, over those 35 plus years of doing this, we recognize that not everybody has the ability to put down a single pay, whether it's just repositioning a portion of their portfolio, pulling it out of some lazy money, mattress money, cash, cash values of old life insurance, whatever the case may be. So we came up with a recurring premium scenario as well. As a matter of fact, in 2022, 66% of our business was based on some form of our recurring premium solutions. So we're seeing a lot more clients leaning towards recurring premiums versus the simple one and done solution. I'll come back to that here in just a little bit, but we've got a number of options. So instead of single pay on the recurring pay basis, we've got a 5 pay. So pay for it over 5 years and then it's paid up. A 10 pay, a 20 pay, a pay to age 95, which would be a paid up policy at 95. However, that's really our annual option, if you will. And we're seeing a lot around that. And I think why people, consumers are really driving towards maybe a recurring premium scenario. One, the advisor may not want to give up AUM, right? I understand that. And so they go that route. One, it could be that the clients don't want, in this very kind of tumultuous time in our economy, they don't want to part with a large sum of money. And then the third piece is when it comes to any recurring premium scenario, we've got waiver premium built in. So whether it's an individual or a joint account, if it's a joint, if one person goes on claim, we'll waive any further premiums due. Obviously, the individual, once they go on claim, we waive any premiums due as well. So that's a great feature of Asset Care with the waiver built in on any recurring premium solution. We also have a return of premium, and I'll get into that here in just a little bit. And then our what we call annuity care, Asset Care annuity funded whole life. And that's really our qualified solution. I'm going to give you some ideas around that here in just a moment as well. So if we move on here, how we stand out above the rest of our competitors, you know, that waiver of premium while on claim, I talked about that on the last slide. Premiums are still considered earned, and it waives both the base policy and rider premiums. So again, one person goes on claim, waives the premiums for both. We've got a qualified bonus, and I'm getting a little ahead of myself there, but I'll talk about that in just a little bit. There's a 0-day elimination period for home health care. So that's where most people want to start any claim process. They want to start at home. We have a 0-day elimination period for that. No elimination period necessary. We do have a 90-day elimination period for facility care. However, any days that they're receiving care at home actually count towards that facility side as well. So great benefits there. Spider rider, I'm not getting into that today. That's a single premium drop-in rider, but it's certainly a unique plan. Again, lifetime benefits, what we're known for here at OneAmerica. It's one of our table stakes, lifetime benefits and joint life coverage. So 2 people sharing 1 policy. And again, all these benefits are guaranteed and premiums are guaranteed from day 1. So no questions down the road, no calls for why I'm getting a rate increase. Everything's guaranteed from day 1. And I'll tell you who loves guarantees: consumers. Your clients love guarantees. They love to know what's there from day 1. So I wanted to give you just some ideas. I told you there's a number of ways that we can fund these, but here's a 62-year-old male-female couple. What I really did for them was build in a $6,000 per person per month LTC benefit amount. To do that, I needed a $200,000 death benefit, but we gave them the lifetime benefits, and their annual premium or the annual benefits on a payout basis would be $144,000. So I really wanted to show you how many ways that we can really design a plan here. So it gets a little busier here, but I just wanted to kind of walk through this just a minute. So first and foremost, single premium, one and done. You know, so they can pay $147,000, almost $148,000 single premium, have this great plan available for them, unlimited benefits, $6,000 monthly LTC benefits per person, and great little solution there. We can use qualified dollars, and again, I'm going to get into that scenario here in just a little bit. Costs a little bit more maybe up front, but it's still a very good solution. I didn't go through all of our recurring payments, but here's a 10 pay, so $20,000 a year for 10 years. We'll get the same plan paid up. A 20 pay, we've got here $12,408 per year. We'll pay it up in 20 years. We've got our pay to age 95. So this is kind of our annual pay, if you will. So $10,000, or a little over, $10,624 per year, would pay on an annual ongoing basis. But remember, any of these solutions have the waiver premium built in. And then another unique way of doing this is maybe single paying the base policy, but doing an ongoing premium for the rider. And in this particular scenario, to get the same plan that we talked about here, it'd be $89,000 or basically $90,000 as a single premium for the base policy, and then an ongoing premium of $41.96 to have that recurring premium on the COB rider, continuation of benefits rider. So lots of ways that we can structure this, right? Well, now I want to just go through a few items here that we can show how to design these plans. These are all hypotheticals. I've done all male, female, age 60, and I've all tried to do this $6,000 monthly benefit amount. Just seems to be fairly simple and straightforward. So a little less premium than the 62-year-olds here. You can see 138, but again, $6,000 monthly benefit per person for life for either of them. Never can run out of those benefits. Moving forward, if we just annual paid the rider, so single pay the base, annual pay the rider, here's your single pay amount for the base policy, $81,620, with the annual premium of the lifetime COB rider of an ongoing $36.70. Again, remember, waiver premiums built in because we are doing some form of recurring premiums. Again, sticking with that $6,000 monthly benefit amount or 72 annual payouts for each one. Here's where I just did that recurring premium paid age 95, our annual basis. So for these two 60-year-olds, $95.18 is what they would pay for this plan ongoing. All right, so some other areas where we stand out in design and advantages here in pricing. Couples, we're always going to be very, very, very competitive with any couple situation that you have out there. So if I go just by the divorce statistics out there, I would say probably most of your, just over the majority, 52% would be married. So I'm going to assume that many of your clients are married. So if you're planning with them, again, we're going to be extremely competitive in couples. Single males will be very competitive there as well, and I'm going to give you some examples on that here in just a moment. Qualified dollars, I'll show you that unique way. We're the only asset-based solution that has this kind of a simple one and done solution. High net worth, do you have those clients that are high net worth? I'm going to show you our return of premium solution. And again, I'm not going into the spider rider today. Single premium drop-in is what that stands for. So here's some niche pricing on single males. So a simple one and done, $100,000 for a male is going to buy him $62.61 as a monthly benefit, unlimited. So ongoing, never can run out of that benefits. It will pay $62.61 each month for as long as he would need care, as long as he is living. Creates that death benefit, so we leverage that up, that $100,000, in a death benefit of $156,531. So annually, that would pay out what, $135. So how quickly does he recoup his $100,000 premium? About a year and a half, maybe a little less. So great way to kind of explain that or put a single male plan in place. I wanted to show you just a little bit of a difference here. We can, again, do a single pay on that base policy for the single male, and then ongoing premiums for the COB rider. So just slightly higher, right? So $101,822 as their initial premium. But look, it leverages up that death benefit even higher, nearly $200,000. And look what it does to his monthly benefit amount. Jumps at almost $1,500 higher per month. And then comes up to an annual payout of $95,604. So how quickly would he recoup his premiums there? Again, fairly quickly, right? Just over a year. Now, what we do here is we've got the single premium for the base policy and then an ongoing premium for that annual. So the $100,000 really goes to the base. He is just paying an annual premium, ongoing premium then of $1,822 for an annual premium for that COB rider. So different way to structure it. Just wanted to show you the power of doing a single pay on the base and recurring premiums on the rider. And again, because there is a recurring basis of this, waiver of premium is built in. All right, now I told you qualified funds is another great solution for us. We are the only carrier that offers this very simple one and done solution, and it is a great solution. Think about where Americans are saving for today for their retirement. Where is that? We're so top heavy in qualified funds. The government is actually looking at maybe how we can tax those in the future. So just heard some rumblings on that. Nothing's in a bill state yet or anything, but there's been rumblings about how maybe they're going to tax that in the future. So why not use some of that qualified money now, protect that whole portfolio today, and have it protected in the future by that long-term care plan in case you have any long-term care expenditures. Now, the biggest thing that I want to point out here, and I didn't talk about this earlier, and I apologize, but asset care, our whole life chassis here, issue ages are from 35 up to age 80. Now, because we're using qualified money here, and that's typically where we use this. Yes, we can do it from IRAs, 401ks, 403bs, even non-qualified annuities. Most of the time, we're using this solution with qualified funds, right? So it's those first three bullets there. But because we are using qualified money, we limit the ages to 59 and a half, largely because we don't want somebody to incur a penalty, the 10% penalty, if they're using that pre 59 and a half. So just thought I would mention that really quickly. All right, so if we look at that just a little bit further. So here, let's say, let's really show a tax efficient way, an effective way to leverage for LTC coverage. So here's a current qualified asset, right? 200,000 in, we'll call it just a 401k, all right? So that current asset would be taxable, and they've got a choice, really two choices right now to say, hey, I'll just self-fund that biggest, objection that we're always running into, or maybe I can use this going forward. So option one here is to pay taxes on that. So if they're just going to self-fund, only use it when they need it, they're going to have to pay taxes on that, and a pretty substantial amount of taxes, right? 25% taxes of that. Only thing that's available for them is 150,000, right? So he's going to pay 25% in taxes. Option two would be to use that prior to and create a long-term care plan to protect the rest of the portfolio. So the whole 200,000 comes over in a direct trustee to trustee transfer. But here's the biggest part. We give it a bonus right off the top. So instead of paying that in taxes, why not get that in a bonus? So now we've got $250,000 that we can use to build a great solution for protecting them from any long-term care expenditures. So before I get into exactly how that works, here's some key points of this. Like I said, we see a lot of joint plans that come into OneAmerica, and so we can use one spouse's qualified funds to create a plan for both. Great way to use, just one spouse's qualified dollars. What's interesting about that, sometimes two people come in and unfortunately maybe one's uninsurable. Well, what if that uninsurable spouse was the one that we're using their funds? We can still do that and create a plan for the insurable spouse. So thought I would mention that. It's a nice little feature there as well. As I said, right off the bat, give it a 25% bonus. So whatever amount comes over, a 25% bonus gets added right to the top of that. And it's a direct trustee to trustee transfer. So there's no taxation that happens there. I will explain how the taxation does get applied here though. So we are going to fund with that total amount now a 10-pay base policy and COB rider solution. Now, when that distribution happens, that will be taxable because it's coming from a qualified scenario or qualified fund to fund a non-qualified solution. There are going to be taxes that happen over that 10-year distribution. And again, I'll kind of show you exactly how that happens on the next slide here. But remember, all LTC claim payments are tax-free. What's interesting about the way we do this, because we're applying that 25% bonus as an income bonus to that amount, if your clients happen to be the age of majority, which now is 72, obviously it's increasing in the future, but if they don't need their RMD for income purposes, the distribution over those 10 years can be countable or used to calculate that RMD calculation. So we're seeing really a couple areas of people using this solution, you know, that late 50s, obviously 59 and a half plus up to basically age 70, but even those later in life who haven't planned, don't need their RMD for income purposes, don't have a long-term care plan, they're using this scenario too, just to satisfy that RMD calculation. So thought I would mention that really quickly. All right, let's look at how this works. All right, so here's a great policy. Again, it's a joint policy, male, female, both age 60. So we're going to take a direct trustee to trustee transfer. I'll call it her 401k. 401k comes over, it was 200,000. No taxation there, direct rollover, right? We give it that 25% bonus, so an extra $50,000. Now we break that into 10 equal parts. I like this hourglass because it kind of describes kind of what's going on, although it's not single grains of sand going from the top to the bottom. It's basically 10 section chunks, if you will, tranches maybe is the better word. So we break that into 10 equal parts, so that would be $25,000 funding over the 10 years this base and rider solution. And you can see what that really creates for them, over $8,000 per person per month in the form of a long-term care benefit. Now, as I said, these distributions are taxable. So biggest thing that you need to remember on the solution, it's a simple one and done solution, right? Just one time rollover, we give it the bonus, but the biggest thing that you need to make your clients aware of is there is taxation that happens from the qualified to the non-qualified. So those $25,000 in this particular solution, or whatever that 10-year tranche happens to be, that will be taxable, and your clients will get a 1099-R for that distribution each of those 10 years. But remember, their age and majority, it can count towards their RMD calculation. All right, so just showing, this is the same scenario, just kind of showing the base and rider plans like I had showed before. So $200,000 coming over, 50,000 bonus, creates a great face amount there. We leverage that 200,000 up to 267, 236, gives them that great LTC monthly benefit amount of $8,017 per month per person for life. It's a lifetime LTC benefit solution. So no matter who needs it, how long they need it, how much it costs, again, we've got this great $8,017 monthly benefit per person for as long as either one of them needs care. Great, great solution. One other thing that I'll mention with this, because of the new Secure Act rules that must, that any non-spousal inherited IRAs must be now drained in 10 years. This is another good little arrow for your quiver, if you will. So you run into your client that says, hey, I just inherited an IRA for my mother or my father, or whatever. So non-spousal inherited IRAs now must be drained in 10 years. Fits perfect for that solution. And what's great about the Secure Act as well, they realize that there's a large portion of America, older Americans, passing on to the younger Americans generational wealth. And so they say that even non-spousal inherited IRA, that 59.5 rule does not apply. So there is no penalty for that. So think about that for some of those scenarios. The last one that I really wanted to hit on here is just to give you another little idea, if you will, around this qualified plan. This is that same male, female, age 60, but now it's the son and daughter-in-law of an 80-year-old mother. So everything that I'm going to show you next is exactly the same as that scenario that we went through earlier. So those numbers have not changed. Where that IRA is coming from. So the IRA is coming from the 80-year-old mother putting a plan in place for her beloved son and daughter-in-law. So again, like I said, everything else here is exactly the same. The biggest difference is just this, where the funds are coming from. So with that, why would we do that? Well, first and foremost, mom's going to pay taxes in her tax bracket, likely lower, correct? I would assume so. Counts towards her annual gift of $17,000. Obviously, that's going to change from year to year as well. Son is still the owner of the life policy. Yes, she transferred the IRA, really passing on a legacy while she's still living, but the son is the owner of the life policy. What it also done is creates this great, nearly 100,000, well, 96, just over 96,000 of LTC benefits per person for life, and it's all tax-free. It also creates a legacy even for her grandchildren if the son and daughter-in-law don't use either any of the benefits or all of the benefits within that death benefit of the policy that's created there. And again, no need to wait to inherit the money.
Hey, Brent. Brent, can you hear me?
She can actually see in her lifetime that, how that money is being used, as opposed to buy a sports car and just a great money up front. So better play to win, well, headed coin. So if they need care, they've got it there. They also have leveraged up benefits. And if they tie, if they never need it, they just get all their premium back.
Hey,
All
Brent,
right,
can
so
you hear
let's
me
go
okay?
into return of premium really quickly, 35 to 80. Yep, I sure can. Was there a question?
Yeah, you were muted for a little bit. Can you go back over that page just real quick?
Yeah, sure. I don't know what happened there. That's weird. All right.
Sorry about that.
Yeah, you tell me where, Tony.
Right there.
Right here. Okay.
Yep.
So this is just an IRA gifting strategy. So the only real difference of the male and female age 60 here is that it's now a son and daughter-in-law. But the real difference is where that IRA is coming from. So the mother is the one who wants to create this legacy while she's still living. She can see the benefits that are happening while she's still living, rather than waiting to pass and pass that on to her son. So the only real difference here is this 200,000 coming from the mother for her son and daughter-in-law's policy. So all these benefits down here are exactly the same as the scenario went through before, but the key items here is that mom pays, taxes in her tax bracket, typically going to be lower than they're in their probably the highest tax bracket or of their lifetimes anyway, highest earning potential. Counts towards her annual gift. Son's the owner of the policy. Creates a life insurance legacy even for her grandchildren. So if the son and daughter-in-law don't use any of the benefits, tax-free benefits to her grandchildren as well. If they use a portion of it, whatever the remainder is, gets passed on to her tax-free beneficiaries. So great way to do that. And again, the biggest reason, no need to wait to inherit that money, just creating that legacy. She can see things happen before she passes. She can see what's going on with that money. That makes sense?
Yep.
Perfect. High net worth, and this is really our return of premium scenario. So I'm going to go through this one fairly quickly. 35 to age 80. Now this one is the only solution where we don't have unlimited benefits. It's a pretty restricted setup. It's going to be a 50-month base policy and a 50-month COB policy. But it's a great way for those high net worth, if they're afraid they don't want to make a decision, great way to just park the funds. Single premium here of 151,000, almost 152,000, face amount of 300,000, gets them that $6,000 per person per month LTC benefits. So the total benefits of 600,000. Now, I like to explain it maybe this way. Here's what they're getting in the bank. So if they're just leaving it in the bank, okay, maybe the interest rates are growing just a little bit more, right? But if they leave it in the bank and they just cash it out, yes, they'll get the exact amount back, probably a little bit more interest than there was just a couple of years ago. If they leave it on, they pass it on to their beneficiaries. Likely will go through probate, so it won't be the full 152,000, if you will. If they live on it, that's so they need care expenses. They only have the 152,000 to do so. Here's what they get with OneAmerica. If they cash out, again, they get their same 151,000, no different than leaving that in the bank, if you will. If they need it if they pass it on, we've leveraged it up in the terms of a death benefit. So they essentially doubled that money. So 300,000 would go on skipping probate and goes directly to the family on an income-free tax basis. If they live on it and need care, that's where we've even created a better leveraging amount of $600,000 for them to use for any of their care expenditures. So great little scenario as well. So I thought I'd quickly mention that. Now I did mention that we have an annuity care chassis as well, annuity chassis, which we call annuity care. So quickly wanted to run through a couple last few slides here. We did a Gallup poll a number of years back and just asked people why, if they had a non-qualified annuity, what do they plan to use it for? So 83% said they plan to use that annuity to avoid being a burden to their family or their children. 73% said they plan to use it for any catastrophic illness or nursing home care. That's all long-term care expenditures. So if we, whoops, I went backwards. I don't know what happened there. Oh, well, this is interesting. Let's do it this way. All right, now we're back to normal. Apologize about that. So the annuity marketplace, people buy them for one of four reasons: growth, tax deferral, guaranteed lifetime income, or to guard against that catastrophic illness. But I always say, is the client's non-qualified annuity where it should be? And I'm going to come back to that here in just a minute, but that's a great question to ask your clients. Do you have any existing non-qualified annuities in your portfolio that I don't know anything about? Can we talk about those? And I'll come back to that here in just a moment. But we use annuity care for one of three reasons. Age, we go all the way up to age 85 with these solutions. Health, so there's 5 knockout questions. So they can answer no to all those questions. If they add the COB rider, there will be a telephone interview as well. But if they don't, if they just did a base only solution, it would just be those 5 knockout questions. So health might be another reason. And if they've got an existing non-qualified annuity, that's another huge reason that we use our annuity care suite. And why do I mention that? Is because of the Pension Protection Act, or PPA for short. I love this slogan, from tax deferred to tax free for LTC. So what do I mean by this? Well, here's an existing non-qualified annuity, right? Gain, we'll call it 50,000. Had it for a number of years. Obviously, the gain is going to be taxable. The cost basis is not taxable, and I apologize. I'm going to say the cost basis is 50,000, and the gain would be there of maybe 100,000. It doesn't really matter. All the gain's taxable. So by just 1035 exchanging that into a PPA eligible, so any one of our annuity care suite, a PPA eligible annuity, it's all becomes income tax free for LTC. Plus, we can add that optional continuation of benefits rider. So that's really what I wanted to talk about today. Tony, if we have time for questions, I'll take a few. If not, I'll let you wrap it up.
Okay, looks like we do have a few. Let me go back to showing my screen, and I know that you're kind of pressed for time because you've got another call that you got to get on. So
Yeah.
I'll do this as quickly as possible here. So one of the questions I have here is, will we receive a copy of this slide deck and explanation PDF or an explanation PDF?
I can create a PDF and send this out, sure.
All right, awesome.
Tony, I'll send it to you.
Yep, and I'll make it available. And then, does this qualify for standalone, required in Washington State and soon California?
Yes. So our COB rider, that continuation of benefits rider, is 7702B by IRS qualifications. So it does count it did count for the Washington legislation, and again, potentially the California as well. And any of the states that are really kind of lining up after Washington, it will count towards that protection.
Okay, and another one, if someone has Medicare with the supplement, why would they need this long-term care or this LTC is what they're
Well, yes. So that great question. Thinking about that, Medicare SUPs and Medicare are all designed for acute care. So care that is going to, get you back to health. Long-term care is chronic care, so designated as needed care for 90 days or longer, while some med sups and Medicare itself will pay for a small portion of long-term care. It's only going to be in a facility type setting, and it's only going to pay for a limited time of days. So really what we're talking about here is chronic care, those conditions that are going to be around for, whether it's 90 days or, 90 years wouldn't be it, but 9 years, 19 years, it doesn't really matter. That's what long-term care is. So, but good question.
And then when you say chronic care, you're also speaking to unable to perform 2 of 6 ADLs, correct?
That is correct. Those are the triggering triggers of the policy.
Okay. And then it looks like one more. They're asking about max age for getting one of the policies and underwriting requirements.
Yep. All right. Great questions. So on our life chassis, so asset care, essentially it's 35 to age 80. We do have that one limitation with the qualified solution being at 59 and a half up to age 80, but again, essentially it's 35 to age 80. On our annuity chassis, we can go all the way up to age 85. And if we're doing a base only solution, we can actually go up to age 87 on our original annuity care solution. So great ways to plan even later in life.
Okay.
Underwriting, I think, was the other one. So underwriting is going to be much easier on the annuity chassis. It's going to be just the 5 knockout questions and a telephone interview if you have the COB. On the whole life chassis, it's going to be both mortality and morbidity. However, because we have 2 chassis, actually, and we're underwriting for both, we can actually table rate where all of our competitors only do accept or reject. We can table rate up to table 8 and up to table 4, still our preferred rates. So, and if we can't offer them a whole life chassis, we'll automatically look at our annuity chassis through the underwriting process to find solutions there. So hopefully that answered the questions.
Yep. Asset care reimbursement or indemnity plan?
Yes, we are all reimbursement versus the indemnified portion. And we feel very strongly about that. We've seen a lot of indemnity carriers fall off, whether it's traditional and or asset-based solutions. And we've got a lot of experience in this, and there's a reason why we're today certainly offering just reimbursement.
Okay, awesome. And last question, and does the rider cost go up?
Rider cost will not change either. So all of these are guaranteed benefits.
All right.
Guaranteed.
I know there's a, I'm sorry, I didn't mean to interrupt. Go ahead.
Yeah, sorry, I said, and guaranteed premiums.
Okay. There are a few other questions. I'll actually get to those after our call, because again, I know that you're pressed for time. One last thing for those of you that are still on the call, if you'd like more information on what we discussed today, if you can respond to this polling question, make sure to get that additional information out to you. And yes, Brent, again, please send that over to me so we can make that available. Also, we've got another one here. Let me leave this up for just a few more seconds. Close that out. And if you'd like to get appointed with OneAmerica, if you're not appointed, we can get that appointment paperwork emailed out to you. So I'll leave this up for a few seconds. Give everybody a chance to respond. All right. And then lastly, we have this happen pretty much for every webinar. The content that we do provide after the webinar, we do get advisors that reach out and say, hey, I've got a client that this would fit perfectly for. So if there is a client out there that you have that you feel that this would be a fit, definitely respond to this, and we'll make sure to get back to you as soon as possible to discuss that.
And Tony, while they're answering that, I am going to say thank you. Thank you to you, to IAMS, and to all of the producers that came today. I really appreciate your time and attention.
Well, thank you for taking the time out to provide this content to us. It's greatly appreciated.
You bet.
So for everyone, thank you again. If you have any questions, you can reach out to either me or Beth Rickliffs. We're the two life sales directors here at IAMS, and there's our email addresses. You can also email us or give us a call on the 800 number. And then lastly, for this content, as well as other content that we do make available for our advisors, you can like us or follow us on Facebook and LinkedIn. And with that, Brent, I'm going to go ahead and say once again, thank you so much. Thank you, everybody, for attending. We do appreciate you taking your time out of your busy schedules to attend this webinar. So everybody have a great week.